So D2L Inc. or DTOL on the TSX, they're a provider of online education through a single cloud platform. The company serves over 18 million K-12 higher education and corporate education users across North America, Europe, and Australia. The stock is currently trading at $12.75 a share, up 19% over the year to date, and has a market cap of $345 million. However, the stock is trading quite a bit lower than its 2021 high, which was just over $17 right after its IPO. During that time, we just saw frothy valuations, however, especially with anything to do with remote work online. So even in the education thing, we saw online courses, they really had that premium valuation at the time because everyone was just pushing into those COVID really beneficiary stocks. And so the stock fell to really the low of $5 range by late 2022, which that really you saw across the industry, especially with those frothy valuations. That's not really unexpected. Like at that time, we would just consider it purely overvalued, especially given the weaker financials relative to what they are now. So really now we need to analyze, does the company now have merit to it, or was it just like many of the other companies that just got lucky with its valuation in 2021? Or is there actually something more to it? Looking at a high level first, we can actually see revenue has grown relatively consistently on a quarterly basis since the IPO, as well general trend towards profitability over time. Now looking at the most recent quarter, fiscal Q2 2025 in US dollars, total revenue increased 11% year over year to $49.2 million. Subscription and support revenue increased 12% to $44 million. Resulting in annual recurring revenue. So that's really that go forward kind of revenue basis, which you can see if you're looking ahead versus looking behind, is $198.3 million. Adjusted EBITDA increased $4.2 million from a loss of $500,000. GAAP earnings improved to a loss of $0.3 million, effectively break even from a loss of $4.8 million. And that's really been the trend for GAAP earnings. It's been either slightly above or slightly below the break-even point for the past couple of years at this point, or I think it's about 6 quarters, I should say. As well, the company is now guiding for fiscal 2025 revenues and support revenue growth of $178 million to $181 million, implying 11% growth from the midpoint. Total revenue of $199 million to $202 million, 10% implied growth, and is guiding adjusted EBITDA of $22 to $24 million, implying 11% growth. Shifting to the balance sheet, it is strong, holding $98 million in cash with only debt, if you consider it, is being leases of $12.5 million. So the cash balance, however, is largely due to that significant capital raised during its IPO at just too high valuations. Although the company has bought back some shares offsetting those large issuances over time, they've also had quite a bit of share compensation. So it's a bit of a back and forth as far as that goes. But the point is the cash balance, at least initially, was really driven by that share issuance. I will note, however, like many subscription services, the cash is actually paid up front, resulting in a large deferred or unearned revenue liability depending on the balance sheet. In D2L's case, they have deferred revenue of $113 million. In a growing business, this means cash flows will actually generally look better than the income statement, versus the other way is normally the reverse. In a normal like manufacturing business, you'll see actually the costs are up front versus this is the revenue up front. So often you'll have a bit of a better looking cash flow statement compared to income statement, and that's no different here. Operating cash flow for 6 months came in at $16.6 million, but had an increase of $19.1 million due to deferred revenue, ultimately really being the cause of that positive cash flow. If you look at the reconciliation to net income for the 6 months, it was a positive $0.3 million. And that's really the big driver, as well as there's some stock compensation in there as well. And that's not to say receiving cash up front is bad. It's overall really a good thing. That's a beneficial thing to have as a business, to receive your cash up front. But it is really a factor you should be aware of when looking at financials, especially when you do see they're quoting they have free cash flow positive and it's growing at a great rate. You need to realize they haven't really accrued those costs yet to earn that revenue. And that's why it's not recognized by accounting principles or GAAP net income. So shifting to valuations, however, the company is currently trading at 1.3 times guided fiscal 2025 sales, which I think, given their recurring revenue, that's their guidance is quite tight range as well. That's a reasonable forward-looking metric. And as well, it's 7.3 times forward EV/EBITDA, which does have a bit more wiggle room because obviously you're not just looking revenue, you're looking at all the cost basis for EBITDA. So it has a bit more of a wider range compared to their revenue. Overall, I would really say for D2L, there's not really any massive red flags. We're not coming into this company where you see massive debt position, no growth, something like that. They have a strong balance sheet, they have growth over time, and at this time they have a really reasonable valuation. However, the company is still really at the break-even point for GAAP earnings, given the front-loaded cash scenario. If the company is really able to push into those GAAP earnings, it gives a bit more weight as it accounts for things like stock compensation, and it attempts to properly match revenues and costs at the point of accrual accounting. So we really want to see that because that really shows as a bit more of a sustainable business. They didn't just receive this front-loaded cash and then throughout the rest of the year, they're just whittle away the cash and then they have another prop up next year and it goes like that over and over again. You'll see that in the odd business that has this cash up front. So that's really something you do want to see. It's either more recurring revenue, of course, but it appear to really be throughout the year, and that's what happens in the accounting earnings, the way it's treated. As well, a couple of things that I really be looking for in this company is how it spends its cash as it is open to M&A, even though I didn't really go into it. They have acquired and have divested during the last year. So really a better picture of long-term M&A is a question we really pose to management, as well as their strategy about acquiring market share, because the education technology market is quite competitive. There's many even public market players. There's plenty private market players. And that's really, you want to see how they compete, how their products line up, where they're looking to grow. Just going through the conference call, they're really looking internationally. Initially, they were primarily a Canadian company, but they're actually having a larger share of their revenue coming internationally now. And that's something which I expect them to go forward through in the future. But that's something we'd also want to ask management about, because sometimes you will have them have a complete shift and that was opportunistic, but I don't believe that's the case, but it is always something you want to ask about. So to close off before the guys give their thoughts, the company really is interesting. It passes that initial sniff test. There's no major red flags. It doesn't have some absurdly low valuation at this time either, though. So it's not you need to jump on it this minute. It's a company that we will continue to monitor, as well as delve deeper into the strategy, likely with call with management, as well as look into the further details and see if it can develop any gap profitability or if any other issues rise, look into their M&A strategy and so on.
Yeah, that makes sense. Aaron, I think you're muted. Where are you going? Anyways, no, it makes sense. I think the other thing is, I mean, it's about 10-12% growth in revenues. I think, having a little bit higher revenue growth would, make it a little bit, more sexy for the market if we had it at a higher level. And then a breakthrough into GAAP profitability, although the free cash flow does look relatively good. It's decent. So, I mean, there are some things to pursue. We may end up booking a call again with management here.
No, certainly. And I mean, of course, with these technology companies, another thing to concern ourselves with that Brett had mentioned as well was just that share-based compensation.
Yeah.
It's this is subject to wide debate because share-based compensation is a means of paying your employees, but it's not accounted for in the free cash flow. So that is one of the things that weighs down on the profitability. Now, in terms of just analyzing whether or not that's a reasonable amount of share-based compensation, that's just another area of the research that we would conduct. But certainly it passes the initial criteria with the free cash flow.
Yeah, on the share-based compensation, I think the last couple of years they've done about 5 million. So it's not one of those tech companies which is 20, 30, 40% of their revenues, which you will see.
Revenue, yeah.
That's not
yeah.
some absurd not occurring. It's a realistic thing that has happened, and we have seen that. And then they just dismiss it and ignore it in adjusted EBITDA, which you will see time to time. Especially, I will say, when companies are buying back shares like D2L has, is you're really shifting from left hand to right hand. You're issuing shares to your employees or senior management, most likely, and then you're buying back shares in the market. It should really, at that point, in my opinion, just be an expense, because it's if they issue to the share, if you did it in the reverse, you issued shares to the market, raised capital, and just paid your employees in cash. it would be a normal expense at that point.